Morning, everybody. We appreciate you joining us again for another session on the continuing saga of the Paycheck Protection Program loans that were initially passed as part of the CARES Act back on March 17th, 2020. We find ourselves in a environment of incredible proliferation of regulations and guidance being published by the SBA in conjunction with the second tax act that was signed by the president recently, and we'll get into the detail in a moment. What we want to do today is talk about primarily the most recent elements of the second draw PPP loan program, as the title of the program suggests, and how it integrates and works with the employee retention credit expansion. Both of those are incredibly beneficial initiatives that should serve to help our clients and help you weather the storm of the pandemic from the business downturn. And so that's the content of today. Before we get started, I do need to, again, thank Mary Lou Harrison and Carissa Krzyzewski. These two people are responsible for a great deal of the effort that goes into putting these webinars together for our audience and for our clients, contacts, and friends. And without their help, we really couldn't do it. I also would like to thank Dawn and Mike, I think, who have made Herculean efforts in trying to keep up with these pronouncements as they've been issued, trying to identify opportunities where we can help you as our clients and our contacts and friends. And hopefully what we have to share today is helpful to everybody that's taken time out of their busy schedules to participate. Our speakers today, Don Johnston in the middle, is a partner in our tax services group. Commenting on his picture first, he noted that he has more hair today than he did in this picture, so I'm not sure really how that happened. Mike Weber, he put his sixth grade picture in to make himself look better, and me, well, I'm just getting beat up from reading through all this, so obviously the picture shows the pain in my life. It is what it is. We've been monitoring coronavirus items ever since the pandemic began. There's been a lot of information that has been provided by Congress as well as the SBA and other lender institutions, commentaries and so forth. And we have a number of postings and material, including access to all the prior webinar recordings associated with the PPP program on our Coronavirus Resource Center, which again is attributable to Carissa and Mary Lou. We ask you to take advantage of that if you have an interest. There's a lot of information on there that can help you through some of these more difficult times for sure. So with that brief introduction, we're going to get started. We are running, as we did last time, from 3 different conference rooms. So Don, Mike, and I are separated, so we can't really yell at each other in person when we're on mute. So there may be a little bit of a bump here or there on changing slides and so forth. We apologize for that in advance. I think that's the safest way to do it, and that's the premise or the protocol or foundation on which today's program is going to be based. So we're going to be talking about, as I said, the most recent legislation, and that is the Consolidated Appropriations Act, which was enacted on December 27th when the president signed it into law. That is an incredible tome of legislation numbering 5,600 pages in length. There's also been several hundred pages of other information that has come out since then guiding those parts of the CAA that we're most interested in. When I say we, I mean not only Don, Mike, and I, but hopefully the people on the phone call as well. That was a $2.3 trillion spending bill. That is a bill that it contains all of the Omnibus Appropriations Act. That's why it was so long. It also included the COVID fiscal relief called the Economic Relief Act. And then there's also in there a number of tax extenders, which is an ongoing protocol, if you will, of Congress extending certain beneficial initiatives in the Internal Revenue Code on an annual or semi-annual basis. So there's those 3 aspects of it. We're going to be talking primarily about the Economic Aid Act, which is the Economic Aid to Hard-Hit Small Business, Nonprofits, and Venues Act. That is really a portion of that CAA, that 5,600 page document, and basically the one that focuses most on the topics that we're going to discuss today as well. The Economic Aid Act does modify the PPP loan that was introduced last year, and it amends and expands the provisions. The PPP program actually expired in August of 2020. Of course, there are ongoing elements of that, as many of our clients have not yet applied for forgiveness, which was permissible under the rules that were released in accordance with that particular legislation. But this reinstates the program again and expands it in a number of different ways, which we have found to be very beneficial to most of our clients. So there is a lot of room there to take a look at it as well. In that Economic Relief Act, I mean, there was $600 stimulus checks. That always gets most of the hype, obviously, as we see the newsreels, you know, the newscasts basically publishing commentary on the $600 stimulus checks on a daily basis. But there were some other changes in there too that are sort of unrelated specifically to what we're talking about today, but are important as well. It increased the above-the-line charitable contribution deduction to $300. Most taxpayers in our portfolio of clients will use a standard deduction now, since they expanded that in the Tax Cuts and Jobs Act of 2017. Nevertheless, even if you use the standard deduction, you'll be able to take a $300 charitable contribution in addition to that standard deduction for 20 and 21, I believe. It increased the federal unemployment benefits. Most of us know that those benefits had run out prior to the reenactment of this particular tax bill, and so that's extended until March 14th. Then it also extended to April 30th the ability of employees to defer payments of certain payroll taxes. Now, most of you will recall that that came about, that fourth bullet, as a result of the presidential orders that were issued in July or August of last summer. There was a lot of controversy, but all it really was the ability of employees to defer the payment of their 6.2% Social Security tax and pay that in the first part of 2021. Very few of our clients elected to take advantage of that or do that, just because of the administrative nightmare that was involved there. And it wasn't a permanent tax giveaway anyway. It was a deferral and had to be repaid. So they were saying in those orders that people didn't have to pay that FICA tax in the last part of 2020, and they could pay it all back in 2021 in addition to their 2021 FICA. So it was not a popular element that we saw being used, but that's been expanded as well now to April 30th as a result of this bill, and employers have until December 31st instead of April 30th to collect that money and turn it into the IRS. The Act overall provides $284 billion more for a second draw program associated with the PPP program. So there's another $284 billion in there that allows us to basically go back and take a second drink at the pond or at the fountain. It clarified that those expenses that would have otherwise been deductible under the Internal Revenue Code that were paid from the proceeds of the first borrowing, and also will apply to the second borrowing if you proceed, that they are tax deductible. A lot of you will know that we've talked about that in prior webinars. We've had issues with respect to how best to plan for year end without knowing for certain how this was going to turn out. This has now been a clarified issue, and so the expenses that you pay for covered payroll and other covered expenses during your covered period, as required under the prior PPP loan rules, is now clearly tax deductible, and so that issue has gone away. It also changes some of the PPP loan forgiveness rules that are in place now. And incredibly, and Mike and Don are going to focus on this a great deal as we get into the program, it's enhanced and retroactively applies the employee retention credit. Historically, based on the CARES Act passed again last March 27th, if you were able to take advantage of the PPP loan program, you were not at that time permitted to also take advantage of the employee retention credit, or the ERC. That's now changed, and we'll talk about in detail in this program how that's changed and how beneficial that can actually be. I think we're all excited that this could be a very substantial economic benefit for our clients in the near term. There's been a lot of rules issued since December 27th. You'll recall last summer we were waiting for guidance from the SBA on how to initiate some of this protocols in conjunction with the PPP program. That's not been the case this time. There's been an incredible proliferation of documents and rulings and releases that have come from the Small Business Administration in conjunction with Treasury in addressing these issues. And so ultimately, what we have is a lot of information to digest very early, and we have a kind of a catch-22 in that we need to get through this information on our end to help you understand it. At the same time, we think time is of the essence in applying for the loans in particular, but the credits itself should be analyzed sooner than later. So this was one of the first interim rules that were issued by the SBA, and you'll recall, if you've not been on prior phone calls, you won't, but if you've been on the calls, the SBA continues to issue what they call IFRs, or interim final rules. The only thing different from one to the next one is the addition of more information and a more recent date. So they build on these interim final rules and they push them out. This one was issued on January 6, 2021, and what it works to do is primarily consolidate all the prior PPP interim final rules, which is important from a simplicity standpoint, make certain changes to the existing PPP rules, including the ones for the loans that were previously already given out and funded, and it adds new rules for some of the new loans under the second draw program. So this interim final rule here that was issued on January 6th is important because it addresses both first draw and second draw and consolidates what's been listed in the past. The other important thing to understand here is this program expires on March 31st under current law. And so the SBA's authority to guarantee those loans, which is part of the benefit and allure, if you will, of the PPP program in the first place, is only authorized through March 31st. So the lenders need to close the loans by then, and we believe that, again, applying sooner than later for a second draw PPP loan, or if you haven't taken a PPP loan before and you now qualify a first draw loan, sooner than later is the answer. With that, I'm going to let Mary Lou do the first polling question. You'll see it up on your screen. We're going to move in and talk a little bit about some of the changes in the PPP programs, and we're going to start again with the issue of tax deductibility of the expenses paid with the initial loan, PPP loan proceeds, which again, as I noted earlier, will also be applicable to the second draw loans as well. And this is the clarification issue that I've already mentioned, so we won't spend a lot of time on it. But after the December 27th Act, the CAA, was signed with the Economic Relief Act inside of it, the expenses paid with PPP loan proceeds are now deductible. And so that's a clear issue, as I said. There is a little bit of an anomaly impact to sole proprietors and self-employed individuals. We're not going to go into that today, but the conceptual problem is that they don't have payroll to pay. And so there's an issue there. And we can talk about that specifically. If you have that issue, you can contact one of the three of us. We'd be glad to talk about it as you need.
Hey, Bob, can I make a comment here?
Go ahead.
Hi guys, this is Don Johnston. So just a quick comment on that. Since that rule changed so late in the year, obviously we couldn't do a whole lot of planning, but we did talk to a lot of our clients about the significance of that deduction for 2020. In some cases, or in several cases for some of our clients, being able to deduct those expenditures in 2020 will now create a net operating loss in 2020. And, you know, as a result of the CARES Act, you can now carry net operating losses back 5 years. So it's important to look at your year-end information, year-end financials, because you may be able to, you know, if you have a net operating loss, you can carry that back and get some much-needed cash flow by carrying your 2020 tax loss back 5 years. Go ahead, Bob.
Yeah, thanks, Don. I appreciate that. That's an incredibly important point. and something that we've observed in conjunction with how these laws have changed. I'm not sure how well, with the speed of passage, how well Congress thinks through all of these things, but there are advantageous avenues to explore in conjunction with different client situations. It is obviously facts and circumstances specific. Nevertheless, if you find yourself in that type of an environment, it again is going to compound the economic benefit to you. I would also note that, you know, this loan, taxable income, was clarified, will not include any EIDL grants. That's the Emergency Injury Disaster Loan Program under the SBA, or loan repayment assistance, including those circumstances where the SBA may have paid, you know, the first 6 months of payments and principals on existing loans that were out there on behalf of prior borrowers. So you have a little bit of room there as well to take that forgiveness, if you will, or the expenses, and not have to include that income associated with those. As a result of the CARES Act, it was clear that the amounts borrowed under the PPP program that would later be forgiven were not taxable. That's always been a clear issue. It was the IRS that came out later, and they were stuck with pre-existing law, so it's not a criticism of them. They were interpreting the law as it was structured at that time, and said that those expenses were not deductible, and that's where this issue centered on for the last 7 or 8 months. The IRS came out with a couple of rulings throughout the year. The primary one, Revenue Ruling 2020-27, where they doubled down on that and said that those expenses would not be deductible. This law is a congressional legislative change, of course. They can change the law to be whatever they want. So the issue that was a sticking point for the IRS went away as a result of this law being passed, and the IRS issued this revenue ruling cited down below, 2021-2, with the goal of basically saying the old pronouncements were no longer operative, and that they were basically obsolete. So again, I think all you need to know is that these are now deductible. We don't need to spend any more time on that today. That issue is a dead issue and has moved in the borrower/taxpayer's favor. The CAA also provided, in a nuance to these rules about tax deductibility, a provision that says that the tax basis and certain other attributes of the borrower's assets, you know, the depreciable basis and so forth in certain situations, will not be reduced as a result of PPP loan forgiveness. If they had done that, then the basis would have dropped. Then you still would have had to pay tax later on when you exchanged that ownership interest, because it would have a lower tax basis for computing the gain or loss. So this was a preventative provision which was meant to make the forgiveness total and permanent. And though it's a technical element of the way, you know, Don, Mike, and I might look at someone's gain or loss on disposition of their interest in conjunction with annual reportable taxable income calculations, it's an important nuance, and it's to your benefit as well. So not only will the expenses be deductible now, they won't work to change tax basis. And so at the end of the day, your tax basis won't be affected by this particular provision of the forgiveness. We would tell you that we've run into circumstances where we're looking at shareholders, partners, members of borrowers, which would be, you know, members, we're talking about LLCs, taxless partnerships, with respect to at-risk rules. There are certain basis issues and certain at-risk rules that might not match up in conjunction with the date of forgiveness for a particular loan. So if you have timing differences in that process, expenses incurred in 2021, 2020, but the forgiveness is not till 2021, there are things that need to be looked at in conjunction with that. For the most part, that's not going to be a significant issue, but we are going to see people that have at-risk limitations and losses and deductions associated with this that are allowable now, that are given to a partner or a shareholder in an S corporation that is not at risk with respect to those amounts. That individual may not be able to get those losses in the current year until the at-risk rules are met. And the at-risk rules were added by the Deficit Reduction Act in 1984. They're far too complex to get into today, but understand that, again, that there's some nuances, and if you are in that loss position, that's something that will need to be looked at as well. Finally, one of the things that had been looked at for quite a long time, that had been something that they've been trying to get a hold of in the banking lending sector of the economy, was some kind of simplified process for looking at smaller loans. And you'll recall in the last webinar, we talked about a simplified form for borrowers with loans under $50,000. They've completely changed the protocol and the process for loans under $150,000, which was the talked about amount for many months now. So for loans under $150,000, there's going to be a one-page loan forgiveness application. That's Form 3508S. That is a form that was just recently released by the IRS, I think just in the last few days. That link will take you to that form. But basically, it's just going to have some very minor required information, a description of the retained employees by number, and then the estimated amount that you spent on payroll from the loan. And then they're going to ask you to keep those records for 4 years for employment information and 3 years for others. That employment information requirement on statutes, you're going to have to be careful on these loan forgiveness documents that you're using to back up your forgiveness request. Those statutes don't really match general income tax statutes of limitations, so holding on to records for specific time periods may differ as you get into these different forgiveness elements of the PPP program. We're going to look at the next polling question, I believe, and then Mike's going to take over and get into the next section of this.
Okay, thanks, Bob. The Appropriations Act, of course, did a number of different things, but with respect to forgivable expenses associated with loan forgiveness, they expanded the scope of what a borrower was permitted to include in order to get their loan fully forgiven. Now, you might not think that this is that big of a deal right now, given the fact that your covered period can now be extended out to 24 weeks. So the reality is that you're getting a PPP loan designed to cover you for somewhere between 8 and 10 weeks of your payroll, and if you have 24 weeks to spend it, perhaps the expansion of the otherwise forgivable expenses is not that important to you. But we're going to talk about why that is important a little later on. So I think it's important for everyone to store this information in the back of their mind right now and consider this as we move forward. You can see the categories here where the expansion occurred. Worker protection expenses, including personal protective equipment, costs related to damaged property, operations expenditures, and supplier expenditures. And while you might think that that's pretty broad, there are specific definitions with respect to each one of those items, and we have those on some future slides here. But moving forward, you can actually utilize these particular expenses even if even prior to the Consolidated Appropriations Act being passed. So you could utilize this going forward, however, you cannot use those for loans that have already been forgiven. Let's move to the next slide there, Bob. And as I mentioned, and we'll note later in the program, these covered expenses are particularly important as you analyze how you're going to take advantage or potentially take advantage of the employee retention credit. As Bob alluded to before, that's a significant item, and so I want everyone to think about the expansion of these expenses. Again, store that in the back of your mind when we get to the retention credit. But these items are available for forgiveness on the application. With respect to worker protection expenditures, you can see in here, expenditures to facilitate compliance with federal health and safety guidelines. I think we've all gone to, Home Depot or, various other stores. You can see the plexiglass that's in there, to protect the workers from the individuals that are purchasing products in the store. So, expenditures on those types of items are now included as part of can now be included as part of your loan forgiveness. Operations expenditures, again, has a specific definition, And those are, payments related to business software, cloud computing services, and various other items as we have listed here, including tracking of payroll expenses, human resources, sales and billing functions or accounting, or tracking of supplies, inventory records, and other expenses. Covered property damages are also included as part of this, as part of the expanded scope, and covered supplier costs as well. And again, you can see the specific definition here on what covered supplier costs mean. I think I would just kind of stop here and comment that the reality, I think, is that the government wants all of these loans to be forgiven in full. And so they're really going out of their way. And I think you've seen this as time has gone on from the original set of rules that had come out, that you only had 8 weeks to spend all this money, and 75% of it at a minimum had to be spent on payroll, and 25% could have been spent on non-payroll items. Now, as we sit here today, as little as 60% of the funds can be used on payroll and 40% on non-payroll items. And what we've done on the non-payroll items is basically expanded it from, again, the original couple of things that could have been included there to include not only those things, but the other expanded items and the expansion of the items in the Appropriations Act. So, we're not thinking that our clients and borrowers should really have a difficult time being able to demonstrate over the course of 24 weeks, whether it's your first loan or your second loan, being able to come up with, whether it be payroll or non-payroll costs, in an amount that would not give you full forgiveness. I think we've seen very, very limited circumstances where somebody would not be applying for 100% forgiveness. The Act did also clarify what covered payroll costs were, and expanded this definition a little bit, and you can see the items listed here, including group insurance benefits, et cetera, and other items that are in there. And I know that's been a question that we have received and continue to receive with respect to what's payroll, what isn't payroll. You can see these items here. While you wouldn't traditionally think those are payroll items, they're not included as somebody's gross wage. They are nevertheless included as payroll costs per definition of the loan forgiveness process. So again, store that information in the back of your mind as we move forward further on in this presentation. I'll turn it over.
Hey, Mike, I would also suggest that, or remind listeners, because we're not going to get into all the detail, that the cap on higher compensated employees is $100,000, but that $100,000 is associated specifically with cash compensation. So those non-cash fringe benefits or employee benefits, such as those listed on your last slide, they're in addition to the $100,000 in determining the borrowing amount under the second draw program as they were under the first.
Yeah, that's a great point. So again, there's all these anomalies in here and things that you can really take advantage of if you know all the the tricks to it. But sort of again, back to my, I think, original point is that 24 weeks is a very significant time to be spending a loan that was really designed to cover payroll for, again, like 8 to 10 weeks of payroll. So, again, we're not thinking that certain clients and borrowers are going to be in a situation where they're not getting 100% forgiveness. But, every little bit that you can come up with to kind of stretch the rules, as Bob alluded to here, these items are in addition to the $100,000 annualized cap on wages for your highly compensated employees. So it's just another avenue to get full forgiveness.
Okay, so let me add on to a little bit to what Michael just mentioned, and those additional costs are now allowed to be utilized for PPP purposes. If you look at the application for forgiveness, the Form 3508, it has been changed and it was updated earlier this year. And it's pretty easy to see. You just have a several additional lines that add those items that Michael just talked about: covered operations expenditures, covered property damage, and such. But that is included in the new application. So one question you may have is, hey, if I've already completed my application for forgiveness and I have 100% forgiveness, is there any reason for me to go back and change my Form 3508? And I don't even know if you're allowed to do that. I'm not sure if you can do that. What I would say, though, is if you're receiving 100% forgiveness anyway, there's really no need or any reason to go back and change, or think that you need to change that form to add those additional costs. That could change if and only if you qualify for the employee retention credit, which Michael and I will talk about in a little bit. And that employee retention credit that I'm talking about would be applicable for 2020 for purposes of getting some money back for 2020. And again, the employee retention credit is applicable for both 2020 and 2021. And the most significant rule change we have is that now you can use both PPP funds and you can use the employee retention credit. So where it didn't matter before how you did that split, because I had many clients who, when they did their PPP first round loan forgiveness application, they completely ignored those other expenses because it didn't matter. They used enough payroll to qualify for full forgiveness. So they didn't even try to gather the information for those other costs, because at the end of the day, it didn't matter. They were getting full forgiveness anyway. And I would tell you that that still does not matter for 2020 unless you qualify for the employee retention credit, which we'll talk about a little bit later. So the next thing we'll move on to is PPP loans over $2 million. So, you'll recall, or you may recall, middle of last year, we were all following the FAQs that were being issued by the SBA. So right about midsummer, the SBA issued FAQ number 46. FAQ number 46 basically said that if your PPP loan, along with your affiliates, if your PPP loan was $2 million or less, then you were automatically safe harbored and you're deemed to have met the loan necessity test. The test that was required to say, hey, did you really need this money? So at that point, many of our clients basically were able to breathe a sigh of relief, because there was a question as to whether some businesses really needed this loan and really needed the PPP funds. So FAQ 46 came out and caused us to breathe a sigh of relief, because anybody under $2 million, you were automatically deemed to have needed the money. Unfortunately, what that same FAQ said was anybody that's over $2 million now is going to be audited by the SBA to determine whether you first qualified for that money, and then two, whether you needed the money. Well, soon after that, FAQ 53 came out. And the title of FAQ, and I'll read you the question on FAQ 53. It says, why are some PPP borrowers receiving a loan necessity questionnaire? So basically, soon after the FAQ 46 was issued, then all of a sudden, some borrowers started receiving this loan necessity questionnaire. This loan necessity questionnaire is a questionnaire that the SBA put out, where they're basically digging to try to figure out how much, digging to see if they should audit your PPP application. This loan necessity form is quite interesting, and I've assisted several clients with the loan necessity form because they're required to fill it out. If you get a loan necessity form from your bank, you have 10 days to complete it and send the information back in. And if you look through the loan necessity form, there are a lot of interesting questions on there. And one of the things that was a little bit frustrating with this loan necessity form is not only were they looking and asking for information as of the date you took the loan out, they were asking for information for things that happened after the loan. So it was kind of frustrating because there was no thought that you would have to provide financial information with respect to things that happened after the PPP loan was received from the government or from the SBA. Bob, you can go ahead over to the next slide. So the loan necessity form, again, the purpose was to facilitate the collection of information, which is kind of interesting, right? There were so many loans that were issued by the SBA in 2020. There's just no possible way the SBA could audit all of those loans, which is one of the reasons they selected loans over $2 million, where they would say, hey, we're going to take a deeper dive into any loan over $2 million. So the loan necessity form, was kind of like a shortcut. In my opinion, it was a shortcut in allowing the SBA to gather some information, because there's no way, even with, even by cutting these loans, this down to loans over $2 million, there's just no way they can audit all of those loans. They do not have the manpower to do that. They do not have the capacity to do it. So we think the loan necessity form is kind of like a shortcut to determine, which loans they're going to take a deeper dive into, and the information included on that loan necessity form is going to help them determine that.
Hey, Don, before we move off this slide, I just wanted to ask you, I've not observed, but I know that there was a kind of a low-level protest against this form by a number of professional organizations representing small business owners around the country, who thought that the form was not appropriate and that this should be modified or at least altered in a manner that would make it more conducive to gaining what you were referring to earlier as what was known or knowable at the date of the application. Because I agree with your comment that there's a level of unfairness with respect to going beyond that date, based on what people could have expected. No one knew what was going on when they declared national health emergency, first time in my lifetime. So my understanding is that there's not been much movement, if any, as of this time with respect to the SBA retracting or modifying that form. And I was wondering if you had anything else on that for the audience.
Yeah, I would agree with that assessment, Bob. There have been, and actually there have been a couple lawsuits that have come into play here, but I haven't heard anything, nor have I seen anything with respect to the possibility of this loan necessity form being revoked, if you will. I will say that, and I think we still continue to tell our clients, if you're over $2 million, maybe you should hold off on the loan forgiveness, because whether you apply now or on March 1st, April 1st, doesn't really matter. You might want to wait until we get some more guidance, or if something may possibly change with respect to this loan necessity form. Because if you look at the loan necessity form, it's a 9-page document, basically an application, and some of the things they ask for, some of them make sense, right? Like, for example, they're looking at there's a business activity assessment section where they're asking you for the gross revenue for the first and second quarter of 2019 versus the first and second quarter of 2020. Well, that's kind of looking forward, right? When you did the application, you had no idea what your revenues were going to be in the second quarter of 2020. So that really didn't change your application, right? But now they're asking for information. They're asking you, hey, tell us what your revenues were in 2020 for the second quarter as compared to your revenues in 2020 or in 2019, so they can see if there was a change. So it's kind of interesting that they're asking for that information. Some of the other stuff they're asking for on this form is stuff relating to the COVID impact. Did you have to spend money to comply with COVID regulations or new laws or something like that? It's also asking you for capital improvements. So if you got a $2.5 million PPP loan and you just happen to have a capital improvement of $4 million, well, is that going to raise more questions at the SBA? Well, I would think so, right? Because that's something that they might look at that and say, wait a minute, did you really have to do this capital improvement? One of the problems, I think the biggest problem with this loan necessity form is there's not a whole lot of room for you to add additional commentary. There's only a couple sections where you can add comments, basically to explain what really happened. You might have had to lay people off, or you might have kept people. If you remember, part of the PPP program was keeping your employees. And what we've done when we've helped our clients do these loan necessity forms, when we've reviewed them, we specifically have put in situations where we would have laid off people if we wouldn't have received the PPP loans, because that's critical, right? That's what they wanted us to do. And I have several clients who, without question, would have laid off employees. And some of them did lay off their employees until the PPP money came in. So, that's information that you have to disclose. So it's very important to think through, and to the extent you need us to review those loan necessity forms, we can do that once you start moving towards actually filing these things. The last thing
go ahead, Dawn. I'm sorry. No,
the last thing I'll say on this loan necessity form is there's a liquidity assessment, a section about liquidity assessment, which is asking you for the cash on hand as of the most recent quarter before you did your application. Well, there's a very big difference if you're a company that had, negative $25,000 in your bank account and you report that in your loan necessity form versus a company that just happened to have $3 million in their bank account when you did the PPP application, right? So, there's things that can be very misleading depending upon the type of business you have. You might be a business that needs high working capital to keep inventory going, so you have a lot of cash on hand at a particular moment of time. So, as we're going through these, just make sure that you're adding as much commentary as possible, knowing that there's really not much room for commentary. In some sections, you're limited to 1,000 characters. And that's not 1,000 words, it's 1,000 characters in certain sections. Go ahead, Bob.
Yeah, just to add to what Don's saying, because I think his points are well-founded, this is not a form to be taken lightly. I mean, if you've got $2 million or $2.5 million in PPP money and you're a company who made owner distributions, or you had that capital project that Don talked about, or you perhaps displaced other debt that was higher interest debt and you used some of this money to pay down that debt, you have to be careful how you disclose that. There's no question. And if they find that you did not need the money, there are going to be appeal processes and hearing processes to move it forward, but you're going to get into a spitting match with the SBA, and it could take a long time to resolve. And at the end of the day, you may not have the loan forgiven at the end of the day. So Don's advice, it couldn't be more timely and more important, is that, have someone take an unbiased look at this. If you have any circumstances that might lead to a conclusion that you didn't need the money in the first place for loans over $2 million, you should be taking great care in preparing this form.
Yeah,
Don,
go ahead, Mike.
One comment here, just with respect to this discussion. There's a question somebody asked, and I don't specifically know the answer to this. I was curious if you had seen this. On the second draw loans, I mean, given the fact that the max you can get is $2 million, is there going to be a loan necessity form for somebody getting the max $2 million loan on the second draw loan? Have you seen that anywhere?
No, I haven't. And that's kind of an interesting thing. And I know I'm jumping ahead by making this comment, but I'll make it anyway. On the PPP Round 2, there's a calculation that you have to perform to see if you qualify. It's a mathematical calculation based upon the change in your receipts between 2020 and 2019. So there's kind of like a mathematical calculation that says, hey, you qualify if you meet these parameters, these metrics. Well, that's pretty awesome, right? So it makes it pretty definitive who qualifies. But with that said, on the application, in the Round 2 PPP application, there's a certification that's very similar to the certification you made on the first round. It basically says that this assumes that you had the necessity, you needed the money. So on one hand, they're saying, this is the metric, but on the other hand, you still have to certify that there was a necessity for the second round of PPP. So I don't know the answer to that, Michael.
Yeah, Mike, I would agree with Don. I think the mechanical calculation takes a lot of that risk away. If you've had a 25% drop in gross receipts, as will be discussed, shortly, it clearly demonstrates a definite need or a definite economic downtrend in your business. So I think that mitigates a lot of that loan necessity requirement, but there's been no FAQs to my knowledge or any IFR questions that specifically say that this loan necessity requirement's been withdrawn. And as Don said, I've seen it as well on the application.
Yeah, and the last comment I'll make on loan necessity before I move on is, again, looking at FAQ number 53 that talks about the loan necessity questionnaire. I'm going to read two sentences, and these sentences are back to back in this FAQ. So here's right from the FAQ. Quote, this certification is required to have been made in good faith at the time of the loan application, even if subsequent developments resulted in the loan no longer being necessary. End of the sentence. The very next sentence. In its review, SBA may take into account the borrower's circumstances and actions both before and after the borrower's certification, to the extent that doing so will assist SBA in determining whether the borrower made the statutorily required certification in good faith. Holy cow, those two sentences take me completely opposite directions. The first one makes me more comfortable, and the second one scares the crap out of me. So that's the end of the loan necessity. So, you know, it's important. And again, you only have to complete that if you and your affiliated groups have loans that are in excess of the $2 million. So let's move on. And we're still talking about PPP Round 1 and some other things that we still, you know, that are still relevant with respect to PPP 1. And then we're going to move on to PPP 2. And again, we still needed to maintain the minimum payroll versus non-payroll, that split of 60-40. And again, for most of our clients, that split was not important, didn't matter, because we had 24 weeks to spend the money as opposed to 8 weeks under the original rules. There are still FTE and salary reduction rules, but again, those pretty much were thrown out the window and they were mostly irrelevant. And the reason they were irrelevant is because, again, you had 24 weeks to spend the money. So if you had eight weeks of payroll or 8 to 10 weeks of payroll and you had 24 weeks to spend it, then even if you did have reductions in your FTEs, the way the math worked out is you could technically have a 50% reduction in your FTE and still qualify for full forgiveness depending upon how much money you spent during the 24-week covered period. And like Bob mentioned, there's still the $100,000 annualized wage cap per employee plus benefits on top of that. And then the covered period, again, 24 weeks, if you choose that. Now, under the new rules that were passed in December 27th, your covered period can be anywhere from 8 to 24 weeks. And as Michael said, we'll talk about that a little bit later as we talk about the employee retention credit. Go ahead, Mary Lou. Next polling question number 3. Have you already applied for your second draw PPP loan? And while you're looking at that and answering that question, I will tell you that many of our clients were eligible to start doing their applications on Tuesday of this week. And I know I have several clients who already have their applications in. Michael, I think you have some statistics on some of the loans that have already gone through the second round application process, right? You want to mention some of those?
Yeah, so a couple of the banks had released information thus far with respect to, you know, their average loan size. And based upon what some practitioners are suggesting right now is that, you know, there would be sufficient funding here to cover all of the applications. We don't know specifically, but just for example, and this is all public information, Wells Fargo said that their average size of their second draw loan was $62,000. And I don't know specifically how that relates to what the first loan process looked like, but they said that, you know, $62,000. And I think JP Morgan had released some information, or maybe, yeah, it was Bank of America. Actually, I'm just looking at it right now. They released some information, said that they received somewhere in the neighborhood of 30,000 second draw PPP loan applications, and borrowers were seeking somewhere in the neighborhood of $2.5 billion. And I think that's leading some people to believe that there would be sufficient funding for this. Of course, we'll have to wait and see. There's no real way to know all that because we don't have all the data from all the banks, and we don't know who's still yet to apply. But some people have that comment right now. So that's just some general information that's been released so far.
Don, I guess I'm up. We're going to talk a little bit about the new loan eligibility, the general criteria, before we get into the specifics of what you need to be concerned with as a borrower under the second draw PPP program. So like the first program, similarly, you're eligible if your company, the borrower, together with your affiliates, are small business concerns, you know, or you're an independent contractor, an eligible self-employed individual, or a sole proprietor. And it is interesting that just the day before yesterday, they released a second draw detail on how you calculate the loan amounts for each of these. So the guidance is very specific to your industry or to your company structure now. And so some of the questions that we had originally had on the first round of the PPP loans were not considered here. So The general criteria, again, as I said, if you're not a small business or the proprietorship, it also applies to companies that, our business concerns a tax-exempt nonprofit organization described in 501c3, which is most of the public charitable organizations, churches, so forth. This is the broadest section under 501A of tax-exempt organizations. A tax-exempt veterans organization described in 501, that should be a bracket instead of a letter 9, C19, so 501c19, and a tribal business concern, and you have no more than 500 employees, or you can go over the 500 employees if you meet the SBA size standard rules on the SBA website. So those are the eligible companies. They also include a company that might be a housing cooperative, an eligible 501c6 organization, which is usually a trade organization. That's a first that was added by this December 27th Act, the first time they've been eligible. Or an eligible destination marketing organization employs no more than 300 employees. Tell you the truth, I haven't had a call to look at it. I'm not sure what an eligible destination marketing organization is per se, but that also qualifies. Also in this one, there's a company that's a news organization. It's majority owner controlled by those North American Industrial Classification Codes that are listed there, or a nonprofit public broadcasting entity with a trade or business under the other codes that employs no more than 500 employees. So those are there as well to understand. And the general eligibility, except for expansion of those who now do qualify, are pretty much similar to what they were in the past, with the addition of the trade organizations, 501c6. The procedural notice 50020076 that you see issued on your slide right now was issued last week. Basically, this looks at circumstances under which certain eligible borrowers may reapply for a new first draw PPP loan or request an increase to a first draw loan approved on or before August 8th, 2020. What that does, and it's incredibly helpful, is that there was lack of guidance as the program came out of the gate back on March 27th of 2020, and people were applying for these loans as rapidly as possible. Everyone here on the call today probably remembers the flourish of activity in trying to get that money first. And in fact, they ran out of money and had to put more money in later in May, I think, as Dawn alluded to a little earlier. But now further guidance came out and said that those people that did not get the amount that they would have been entitled to had the guidance been released at the date of their application, in certain circumstances, they can go back and get additional monies. Let's talk about that in a simple example. If after the original PPP loan was submitted and newer interim or final rules would have increased the total, then you can get that relief. So the example is a partner in a partnership. When the rules first came out, there was no guidance on partnership income and partnership guaranteed payments and how that was supposed to be integrated into the overall borrowing total. And so a lot of people were applying primarily in conjunction with their employees, especially smaller entities without proper guidance that we've observed. And those particular entities did not include any compensation attributable to the partners. Guidance came out, I believe, if I'm correct, April 14th or April 15th of last year. And if you applied between, March 27th when the law was passed and April 15th when that guidance was issued, you may not have included any amounts in that initial borrowing for partners. In that circumstance, you have an ability now to go back and recompute that initial PPP loan and get that amount that you would have been entitled to anyway at the current time. And so you have this opportunity, even if you borrowed under the PPP program as a first draw borrower, you now have a chance to go back and recast that first draw and put yourself in a posture of getting the money that you were originally entitled to. The other circumstance that we've observed where that is the case is in certain seasonal businesses where people use average payroll over the 12 months, understanding that they have very few employees perhaps in the winter and in the deep fall in a landscaping business or that type of business. those individuals would have had a smaller loan amount using an average of the 12 months. Alternatively, if you can use rules that were rendered later, which allow for any 12-week period to be used as the base for the compensation that's considered in conjunction with the loan, you could end up with a much higher loan. And so you have an ability to go back and increase that calculated total of the original loan. That's an important provision in this particular law, and I think it's something that's important to understand and think about. The one thing I would say that they cast concern about that is no loan increases are going to be permitted under the notice if the SBA has remitted a forgiveness payment to the lender on the first draw loan. So if you have applied, if you've received the forgiveness on the first loan, even if it wasn't the right amount, you can't go back now. I would also say that the increase in the first draw loan can only be made by the same lender. To my understanding, and Mike and Dawn, you can jump in if you understand it differently, there's no requirement to use the same lender generally that you used for the first draw loan for the second. But if you're going back and trying to recast the first draw loan, you have to go back to the lender of original record. So you have to.
That's correct. And just to provide more context on your partnership example, just to expound upon that to the seasonal example, I actually already worked with a client where they are in fact a seasonal business, and just to give everyone the magnitude of how the numbers could change, and in their particular business, they're actually just closed for 4 months of the year and open for 8 months of the year. And so when they first did their application, before they were working with GYF, they just took the total 12 months and divided by 12 times 2.5, and they came up with a first draw loan of about $100,000. And when we looked at the seasonal rules as they are now, their loan should have been, if they would have known the rules, somewhere in the neighborhood of like $215,000. So they've already submitted a request to get that increase. Now, on top of that, since they know those rules for the second draw loan for which they do qualify, they're actually going to go for another $215,000. So for them, the first increase was $115,000, and the second increase, by virtue of now knowing the rules, was another $115,000. To them, this was a $230,000 or $250,000 issue. So when you integrate the two, that's how much additional money they would be getting. But this specific rule to them was worth $115,000. Now, we haven't made it all the way across the finish line yet, but we've submitted the request. So you could just see some of the opportunity that's out there if something did change after the fact that you didn't know about.
Yeah, thanks, Mike. That's very helpful. So again, it's something that if any of the attendees at today's webinar have that type of fact pattern, that type of situation, you know, I really suggest, and I think Mike and Dawn would confirm, that you reevaluate what your first draw loan was in conjunction with the seasonal rules that are out there, and with this ability, this capability, if you will, that's enabled by this act, gives you that opportunity to go back and get more money on the first loan. I'm not sure why you wouldn't do that. I mean, you're going to get the second loan as well, probably, and if you go back and get the first loan, you can you know, double up your effort. The other thing I would say is, even if you don't qualify for the second loan because you don't have the drop in gross receipts or you weren't shut down by the government, you know, if you can't qualify for that, but you did qualify the first time around, I think, you know, to go back and get that money again gives you a little bit of an economic boost that you're entitled to under these programs. There are special provisions in the CAA under the Economic Relief Act for partnerships, seasonal employers, farmers, ranchers, etc. These people that actually paid back their first draw PPP loan. So for some reason they decided not to take it after they had qualified and received the funds. So they repaid it back to the bank or the SBA at the end of the day, as long as they did that before December 27th, 2020, or those that basically took a PPP loan at something less than the maximum they could have taken. Those are both special situations that this particular law and the most recent guidance gives you an ability to reevaluate. So, you know, things change. You know, you may have been in a situation where you felt for some reason you didn't need the money or didn't want that money. your business may be, more economically challenged now than it was when you returned those dollars, you have a chance to go back and get those again.
Hey, Bob, is there a requirement there that you have to show necessity? And now you just mentioned it, in an example where you have a client that thinks that, their business went south. But what if your business didn't go south? What's the loan necessity requirement now that you're saying, oh, I should have taken this loan because everybody else did? Why didn't I do it? Because my CPA didn't tell me that I could, so I didn't. I don't know the answer. I don't expect you or Michael to know the answer, but I think it's interesting when you sit back and think, what's the requirement here as far as loan necessity is concerned?
Yeah, I think that's a good question, Don. And I think really what happens is you revert back to the first PPP loan rules, because there is no mechanical 25% test for the first draw loans. And so if you're going back and recasting your first draw loans, I think you're going to be making the same certification you would have been making under the prior rules prior to this CAA being passed at the end of December. And so you are certifying to the best of your knowledge that this loan is necessary moving forward, and it could be evaluated later. Now, how much effort the SBA is going to put into verifying that, especially for loans under $2 million, that's a question I don't think, as Don said, that we have an answer to at this time for those listening on the program today. But it is an interesting question, because anytime you're going back and trying to somehow ameliorate those first draw loans and change them or get additional monies, I think you're moving out of the new rules for the second draw loans and being recast back into everything that was in place for the first draw loans in the first place. You can also get a first draw PPP loan, and this is kind of an interesting format. It can be requested under this particular SBA notice that came out January 13th if you did not receive a PPP loan previously. So it's an interesting thing, because they present this in the Economic Relief Act as the second draw program, but you can go back and get a loan under this notice, a first loan, if you didn't borrow any money last year. So the amount of the first draw loan, or the increase when added to the original PPP loan, can't exceed the original total of $10 million for an individual borrower, which was the cap under the prior rules, or $20 million for a corporate group. So that's a big deal too, because if you didn't go get a PPP loan before, just because these are second draw loans, for the most part, the focus of the legislation, doesn't mean you can't go back and borrow an initial loan under this second program as well. So it adds a little bit of a complexity in how you apply. I think what we're finding is some of the smaller banks, outlying banks, are struggling, as is everybody, to digest all of this information. But my suggestion would be, and Don and Mike chime in if you have any thoughts, is that if you get a banker that doesn't seem to be open to helping you because he or she doesn't seem to understand the rules, we'd be more than happy to try to send them to the proper guidance so they can get their head around it as well, and their groups. The bigger banks, they have sophisticated service teams, and they're pretty much on top of these things, but there may be some communication issues, especially for smaller borrowers, and we're always glad to help. Some additional guidance on January 17, 2021. So this one was over the weekend, I guess last Sunday. The SBA issued additional guidance. I would tell you, as a presenter today, I check my emails before I go to bed at night, and every night I get something from Mike Weber saying, here's another release from the SBA. Even though I'm looking all day to like 6:30 or 7, I still get that update from Mike at 11:30 at night every day on new regulations. And so I did see this on January 17th at 9 or 10 o'clock on Sunday evening. This guidance basically was put out for purposes of calculating the maximum amounts of the first draw PPP loans, but also sets forth documentation requirements. So it includes 12 pages of Q&A on how to calculate the maximum loan amounts by entity. So that, again, is guidance that we didn't have in the past, that we struggled to put our heads around how best to apply for those initial PPP loans. Now there's very specific guidance in these notices, in this particular notice, that basically separates it, including self-employed businesses both with and without employees, partnerships, limited liability companies, S Corps, C Corps, and nonprofits. So there are very specific rules in this guidance. The unfortunate part of this is, I don't know that's too unfortunate, but I mean, there's no citations on here to cite. All you have is an SBA issued guidance with a title in most cases, and then a date on the top. So this link will take you there that Mary Lou set into the slide, but you don't have any reference, document references for these guidance releases that are coming out of the SBA at this time for the most part. This guidance, it does describe the payroll costs using calendar year 2019 as the reference period for payroll costs. However, borrowers are also permitted to use payroll costs from 2020 as you'll see, and this we'll talk about more. So that will go to polling question number 4. We're going to talk about second draw PPP loans. I haven't been interrupted, so I have a big shuffle of papers here, and I can't find where I start and stop. So apparently I'm still moving on. If Don or Mike need to stop me, feel free to do that, guys. So we're still talking about general criteria for borrowers who previously received PPP loans. So that's the limit. So for those borrowers that are looking at second draw opportunities here, you must have been in operation as of February 15, 2020. You have to have a 300 employee limit. You know, you have to have used, or you have to certify that you will use the full amount of the proceeds of the original PPP loan. So you do not have to have proven that yet and had forgiveness yet, but you have to have demonstrated that you used that. For most of our clients, that covered period will have been done by December 31st, clearly, and by the time that you apply for these loans. So this second loan, so you should be able to certify to that without any problem. You must have gross receipts, and this is the mechanical test that Dawn was talking about earlier, and this is critical. Your gross receipts must have decreased by at least 25% during any quarter-over-quarter analysis comparing 2020 as compared to the same exact quarter in 2019. Now, I did have a question from a client in the last week. Can it be just any 12-week period? And I think the answer to that is no. I think it has to be calendar quarter over quarter. Mike, Don, I don't know if you know anything different about that, but when you look at the document rules, it seems that they're looking for that proof on a quarterly financial statement. So it would be hard to imagine that 12 weeks, any 12-week period over any 12-week period in 19 is going to work.
I would agree with that comment there. I've seen nothing that suggests you can manipulate it in any way other than just calendar year quarters at this point.
Yeah, I agree as well. Okay, so you know the borrowers under second draw program, again, they can be nonprofits, self-employed, both with and without employees, sole proprietors, independent contractors, as well as the businesses that we mentioned before.
Yeah, hey Bob, one comment on that 25%.
Sure,
go back to that slide real quick, if you don't mind.
Sure, yeah, absolutely.
Okay, so gross receipts must have decreased by at least 25%. Now, make sure you go back and actually look at your gross receipts for both 2019 and 2020, because, you know, right off the top of your head, you might be thinking, you know what, we had a really good 2020. I can't imagine we had a decrease. But you could be in a situation where you had a quarter in 2019 that was so ridiculously, outrageously high that it is possible you still have a 25% reduction. For example, let's assume you're a law firm, and in the first quarter of 2019, you had a class action lawsuit that was settled and you got a big paycheck. Let's assume it was, you know, $100 million paycheck because of that class action lawsuit. Well, because you had that huge amount of income in the first quarter of 2019, it will not be difficult for you to show a 25% reduction in the first quarter of 2020. So don't just, you do need to look at the actual comparison of your receipts. And I think we're going to talk about what receipts means here in a couple seconds. But you know, you really should go back and look at the numbers just to make sure you either qualify or don't qualify.
Yeah, great point, Don. The first and second draw PPP loan reference period. February 15th, 2019 through June 30th, 2019, or alternatively, January 1st, 2020 through February 29th, 2020, or obviously you can defer to special seasonal rules that have been promulgated by the SBA through their FAQs.
Yeah, and that's an important slide. I've been getting a ton of questions in this area. If you remember back to the first loan, this is with respect to your full-time equivalency quotient that you need to calculate. And so if you're using, 2019 payroll and comparing that to how many full-time equivalents you have right now, there could be, an issue there. And so, the question was, okay, well, what am I comparing my current period to? And that's why this slide's in here. So those are the reference points that you have. And that guidance, as Bob has suggested many times throughout this presentation, that was just very recently released, that those are the rules for your reference periods.
Yeah, and keep in mind, we've received a number of questions, Mike, Dawn, and I, on well, what happens if I'm going to use my reference period, February 15th, 2019 to June 30th, 2019 for my FTE reduction issue, and my covered period doesn't line up with a similar quarter in the current year. And that's not an issue, but you do need to understand ultimately that these are the governing FTE reduction measurement rules, and they are specific, so they need to be adhered to in conjunction with requesting your forgiveness. So when you're borrowing money, and I do see people making this assessment when you're looking at how much PPP money you can get, and you're trying to evaluate forgiveness at the same time, you have to understand that your covered period in which you have to make these payments, in which you have to maintain these FTE equivalent employment levels, may not match up, exactly with what you requested in conjunction with the original loan. Let's talk a little bit about gross receipts and this idea of a decrease in gross receipts and that criteria. Now, remember, what we're talking about is the fundamental rule that we already spoke of, where you had a quarter-over-quarter drop between 2020 and 2019 in conjunction with the gross receipts of your company on a quarterly basis. So any quarter in 2020 compared to the identical quarter in 2019. And what we were finding out a great deal is that, originally the COVID pandemic kind of began, and the shock wave was really in the second quarter of 2020, but a lot of our clients were able to move forward successfully, not because of a great effort in that second quarter, but because they had a great effort, as Dawn referenced, in the prior year, and then maybe in the first quarter in generating orders and so forth, and they were still manufacturing or distributing those products or moving through their service offerings in that second quarter based on work that had been done in the fourth quarter of 19 and the first quarter of 2020. So those particular entities didn't start to see a hurt, if you will, or a pain until later in the year. And for some companies, that was the fourth quarter, that they still had trailing decent results in the third quarter, and they get to the fourth quarter. So the outcome of the rules, the benefit of the rules, is that you can choose any quarter. So it just has to be matched one year to the next. So what do we talk about when we talk about gross receipts? Well, it kind of looks like this all-inclusive Code Section 61A of the Internal Revenue Code, where you're basically talking about all revenue in whatever form. So whatever form received or accrued in accordance with your particular entity's generally accepted accounting methods, from whatever source, including from the sales of products or services, which would all be obvious, interest, dividends, rents, royalties, fees, commissions, reduced by returns and allowances. So that's what it kind of includes. Now, if you include in that top line number of your revenues and your gross receipts, sales taxes collected by customers, or transaction information revenue from intercompany, domestic or foreign transaction proceeds, or amounts collected from others, and first draw PPP loan forgiveness, which would be unusual, but if it's up in that line, it's all excluded from your gross receipts number. You don't have to consider those, and you back those out in doing your quarter-over-quarter comparison. I would also note that all other things are included, and that's an important distinction that needs to be considered in conjunction with looking at this gross receipts decrease. You have to, generally a business that uses subcontractors, is going to get that money in their gross receipts line, but they're going to pay it out, directly underneath to the subcontractor expense line. Those are not going to be excludable from the gross receipts calculation, so they have to be put in there as well. So if you had more work in the fourth quarter or third quarter of 2019 and you were using a lot of subs, but your business is drying up in 2020, in the same quarters, you have to get in there and do that analysis to see how that's going to affect your gross receipts calculations. So subcontractor cost reimbursements for purchases that a contractor makes at a customer's request. Perhaps you have a construction company that's buying railings for a porch that they're adding onto a house. Those costs as well will be included in there. So is investment income and employee-based costs such as payroll taxes. So those are all going to be included in conjunction with the determination of gross receipts. This example is in this Small Business Administration Release 2021-0002. Borrower has gross receipts of 50 grand in the second quarter compared to gross receipts of 30,000 in the second quarter of 2020. Obviously, there you have a 40% decrease. The requirement is 25%, so the criteria is met to be able to get this loan. And so ultimately, you have an ability to go in this circumstance, in this example, and obtain this second draw PPP loan. There was this top line overview of second draw loans, which was issued by the SBA. That's some additional guidance, which is linked here for you, but it provides a little bit more detail on these second draw loan requirements that I'm talking about. And while the general loan rules apply pretty much as they did in the first draw loans, there are some significant differences, as we've talked about, that you should be concerned about and make sure that you're paying attention to as you apply for these second draw loans. Now, the day before yesterday, there was a very specific 18-page document that came out on how to calculate second draw loan eligibility and amounts. And so this document is meant to assist business owners in calculating their revenue reduction specifically and payroll costs and the relevant documentation required to support those calculations. So it helps you to determine, how much, well, first, whether you're eligible, then how much, and then what kind of records do you need to back that up. That's an important document, again, accessible through that link, something that we're paying close attention to and trying to digest. As we said, it was released less than 48 hours ago. There's also a process set forth in making the total second loan determination and the January 9th guidance for each type of entity. And that's important as well, because if you're going to be using tax returns and so forth, it goes through and tells you mechanically how to make those calculations so you get the loan calculation correct. That's the place where people under $2 million on the first loan and the second loan can still be audited by the SBA. There's not a circumstance where you're going to be challenged under $2 million for meeting the loan necessity requirement. As Don said, you receive a safe harbor on that because your loan doesn't exceed $2 million. But the mechanics of the calculation, how much you borrowed and so forth, you still can be audited on that and looked at by the SBA going forward. The likelihood of that, I think, is pretty small for most borrowers, simply because they don't have the resources, as Don alluded to be able to do a widespread audit examination process. Nevertheless, if you're between that 150 threshold and the 2 million, you may have some room for audit later. You're going to want to be careful that you keep the records and you document it the right way. This guidance is extremely specific, as the slide says, and should be considered in conjunction with the application process. So some of the provisions in there that I think are important that you need to think about, the borrowers are permitted to use either 2019 payroll or the 1 year preceding the new loan, 2020, for calculation purposes. So then you're going to get, 2.5 times your average monthly payroll, as you did with the first draw loan. And then if you have prefix 72 industry codes, which basically are the the hospitality industries, the hotels, bars, restaurants, etc., you can use a 3.5 times multiplier. You know, I don't think many people on the call today would argue with the fact that that industry's been really crushed through all of this. There are also some restrictions set forth on seasonal employer calculations. As Don alluded to, I think earlier, the maximum second draw loan is $2 million. There's an additional cap of $4 million for businesses that are part of a single corporate group.
Hey, Bob, can I make a quick comment there?
Yeah, please, Don.
Go ahead. Yeah, go back to that last slide.
Yeah.
I think, and my interpretation is, if you know, since you can use either 2019 or 2020, I think the floor of your loan should be at least the amount of your 2019 loan, right? Because if you're picking the, you know, to the 2019, you know what that number was, right? So if you're still using 2.5, when you calculate what your PPP round 2 loan should be, it shouldn't be any less than your first round PPP loan.
Yeah, I agree with that. I mean, you and I have talked about that offline, and I think that's extremely logical. And I don't know why you would pick 2020 if you can get more money using the 2019 number. So I think what you're saying is absolutely correct.
And actually, I was talking to a client yesterday because that issue came up, and he told me that his PPP application was kind of, in a way, already completed by the bank using the 2019 numbers. You know what I mean? So his online application already had some things filled in for him, and he was curious, like, wait a minute, this already includes the information for 2019 and gives me the same loan amount. So I assume the reason for that is the banks should have told him, hey, you know what, your loan should be at least the same amount as 2019. Although if you use 2020 and it gives you a bigger number, you just have to enter the information.
Yeah, that's good advice, and I think people should be looking at that second draw loan request with that point in mind, that it probably is not going to be lower. I can't imagine why it would be lower than the original loan that you had in the first place, because the parameter 2.5 times, you know, once you qualify, it's 2.5 times, and it should be fixed at that 19 amount at the minimum. The program dates, obviously, you know, as Don talked about, or Mike, one of them talked about the bank starting to take information last week. I think on Tuesday of this week, the 19th, I think they started taking loans applications in all sectors of the banking industry. I think at first it was just a few extra days for community lenders, community-based lenders, but now it's all lending institutions. Started earlier this week. The program expires at 3/31/21. That's the last date that the SBA is authorized to issue these funds. So, you know, it goes out till then, or until the funds are depleted or expended in full. Again, that number, I think, is $284 billion that's available here. First-time applicants can still apply. We've talked about that. They're not subject to the PPP II restrictions. There are special rules there for new businesses that started in 19 and or 20 that you can take a look at. And within this legislation, there's special amounts that are set aside for first and second time applicants that are sole proprietors, self-employed individuals, or businesses with less than 10 employees. There was a lot of political backlash, everyone will recall, last summer when there were some very substantial companies borrowing these monies, and they were never intended to basically service those people, and now there's special amounts set aside here to get us to where we need to be. The application dates, there you have them. I guess I already talked about it. 111 on the community bank financial institutions took the applications. 119 for the all other eligible lenders as well. The loan application itself was issued by the SBA on January 8th. It does include, as Don alluded to, the uncertainty and loan necessity certification. I've not read, and as Don mentioned, he's not seen specifically whether that applies from a narrative standpoint. It's not included in any of the questions that I've read that have been published by the SBA. But I think the fact that it appears on the application is telling, and I think it's important to understand that ultimately you are certifying that you need that money still. But as I said, I think there's some of the teeth has been taken out of that by virtue of the 25% test. If you're getting the second draw loan in the first place, you obviously have seen this 25% drop in your gross receipts as we've discussed. The forms, SBA Form 2483 for first draw applications, we talked about those circumstances where those are going to be applicable. 2483 SD, I guess, second draw for the second draw applications. So pretty straightforward. I want to finish up this little segment by talking about some of the documentation requirements, because generally those documentation requirements have been the same as the original program in the CARES Act for both the first and second draw PPP loans. However, there is certain safe harbors and other information that may be permissible if they apply to you. So some of it is using this, some of it arises because you as the borrower are using the same exact information in 19 for both the first draw loan and again in the second draw loan. So to the extent that that second draw loan is based on that same 2019 information, if you use Don's example, you know, and basically base your loan computation amount on that 19 information, that's allowable. They already have that information from last year. As long as you use the same lender, there's no further documentation requirement. And so you've already met that to get that money. It's kind of an interesting thing. I don't know, if Don, if you and Mike have anything to add, but I mean, in most circumstances, once you meet the 25% test, making this particular application should be pretty cut and dry because, as Don noted, it's not going to be lower. You know, you're not going to take a lower loan by basing it on 2020 if 2019 is permitted. So if they already have that information in the bank system, as he indicated, should be a pretty cut and dry process. The second draw guidance that was released on Wednesday of this week includes information on what is needed by you as a borrower to corroborate the idea, the concept that your particular business sustained at least a 25% drop in gross receipts. Now, we've already talked about what that drop is. Now we're talking about what do you have to do to verify that, what do you have to keep in your records to demonstrate that. Those are set out very specifically in this rule, those requirements. So there are quarterly financial statements for the entity that's required. If those financial statements are not audited, the applicant must, quote unquote, sign and date the first page and initial all other pages attesting to their accuracy. So basically you're suggesting, you know, that the statements that you're going to base this on, this 25% determination, which determines your eligibility, that they're accurate. You know, alternatively, quarterly or monthly bank statements can be used showing deposits from the relevant quarters, you know, a second quarter 2020 over second quarter 2019, for example. But in these cases, the applicant, you are going to have to go through there and annotate which of those deposits of the bank statement constitute gross receipts in conjunction with the definition and are not something other than that, such as capital infusions. So this doesn't look like much on the outside, but for most of our smaller clients, they're not going to have audited quarterly financial statements. And so this does present another circumstance where instead of having an outside accounting firm attesting, if you will, to your second quarter statements, you're going to be making that same attestation as the borrower, basically certifying in a way that the information on those documents are accurate. You know, very small businesses are probably only look at their financial statements in a financial statement format once a year when they're getting ready to do their year-end work in their tax returns. But they're going to have to come up with a manner in which they look at this on a quarter-by-quarter basis and come up with that gross receipt. It's unclear in that information if they're looking for a full set of financial statements. By saying full set, you know, I would say for smaller companies, a balance sheet and income statement and calling that a financial statement, or if you can just have an income statement print out of your QuickBooks and sign that and attest that to the best of your knowledge, that's what your gross receipts are for the third quarter 2020. And here's another QuickBooks printout for income statement that says that's what's required for 2019, and you have the requisite drop. I don't know the answer to that. But I would suggest that I don't think it's their expectation that you're going to have accountants put together your second quarter statements year over year to do that. certainly, if you wanted to incur that expense, if you're a larger borrower, and that's going to give you more clarity, then I would suggest that you move forward with that type of approach. But otherwise, smaller entities, I think, are going to have to basically do the best they can in this and just make this attestation to the best of their knowledge. If you use an annual reference period instead of the quarter over quarter, and you can do that if you don't have the detail and you don't want to do that, if you can show that 2020 clearly shows that you had a 25% drop year over year, then you clearly had that drop in one quarter, right? Somewhere along the line at least. So if your 2020 returns are not yet filed, then you can apply using the forms. You have to fill them out as if they were basically already completed. You need to compute the relevant gross receipts value for that return, sign and date it, attesting that the values that you put on that gross receipts computation on that return are going to be the same as those that will be filed on the entity's final income tax return when it's put into the mail for the IRS. So that's kind of an interesting dichotomy. You can't just put it on a statement for the year, sign the statement like the other attestation, at least at this time, and tell them that to the best of your knowledge, these are your gross receipts for 2020, and I expect them to match the tax return. Here, they're very specific in wanting you to fill out the forms and compute the gross receipts on those forms as if they were the tax returns. If you are using the annual income tax returns, your annual income tax returns to demonstrate a gross receipts reduction, then the guidance provides the computation details in question 5 by entity type, whether you're a sole proprietor, whether you're a not-for-profit, an S-corp, a partnership, an LLC, etc. So it goes through and actually tells you that if you're a partnership, it's on form 1065 on this line, and it's the total of line 3, 5, and 8. I'm not saying that's the lines. I'm just giving you an example, but it's giving you that kind of specificity in how to prove that 25% decline. I would also say, if you are requesting a second draw loan in excess of $150,000, that's the threshold where an evidence of a reduction in gross receipts is going to be required within the loan application. I don't have an answer as to whether you are borrowing $150,000, whether you qualify for 180 and you decide to take 150, whether or not you need that evidence or not. I mean, I would suggest that you probably don't, but there's no clarification on that as of this date. If you're requesting a second draw loan of 150 or less, the reduction in gross receipts is required, but not until you request your loan forgiveness. So understand that you need the evidence over 150 at the date of the application. For loans of 150 or less, you're going to need that same documentation at the forward point when you request your loan forgiveness. So if you do have a smaller loan, if it's going to be under 150, you don't have to worry about that whole other step that I mentioned above, computing a tax return and using that as evidence and certifying that tax return is going to tie to the tax return that will ultimately be filed with the Internal Revenue Service. It's a little tricky, but that's the mechanics of the documentation requirements. And while they're not perhaps the be-all and end-all, I think the banks will probably try from the lender side to comply with those collection requirements as best they can. So you need to be prepared for that as well. We have another polling question up, and then I think Mike's going to take over.
Yeah, and Bob, let me make a quick comment before we move on to the ERC. We didn't talk a whole lot during the presentation about the affiliation rules and when you need to combine two companies. And, generally for PPP Round 2, you have to have less than 300 employees, but you have to calculate those 300 employees based upon the affiliation rules. And generally, just in general terms, without going into the detail, the affiliation rules require you to combine companies when you have more than 50% ownership owned by one person. So if Don Johnson owns the company and I'm the only owner of that company and I have no other investments, then I don't have to worry about the affiliation rules. Whereas if I own 100% of company A and 100% of company B, it's more than likely that the affiliation rules come into play and I have to combine the employees for both of those companies. So the affiliation rules are very complex. There are a lot of different factors that come into play, and there are situations where you could have Don Johnson can own 10 companies and they have 100 employees each. There are ways where under that scenario, you can make it work depending upon certain factors. So it's very complex, way more outside the scope of what we wanted to talk about today, but I just wanted to mention it because it is very important.
Yeah, that's a great point. The other thing I would add to what Don's comments is when we talk about affiliation rules, that's, your executives at GYF. I mean, when you talk about the PPP loans and the governance of the PPP program, you're really talking about Small Business Administration affiliation rules. When we get into the employee retention credit, we'll be talking about affiliation over there as well. Those rules are governed by the Internal Revenue Code. So you have different mechanics of the affiliation rules, and the SBA rules are generally pretty broad in that they're looking at, what they refer to on their website as quote unquote a mutuality of business interest, which is different from the IRS rules, which are generally very mechanical and very ownership specific. So we'll talk about that just a little bit. As Don said, that's kind of beyond the scope of today's because it is so facts and circumstances specific and would take more time than is worth sharing with an audience like this. But we're available to discuss those rules if you have any questions on them at all. Mike, you ready?
Okay, we're going to move on to the discussion surrounding the employee retention credit. Back when the CARES Act was passed in late March, there was a provision in there that permitted employers to take advantage of what they were calling the employee retention credit, but businesses really did not pay attention to this because of another special provision in there that said if you went down the pathway of obtaining a PPP loan, you could not benefit from the employee retention credit. So everybody or most businesses never even bothered to look at the employee retention credit rules because, again, you went down the PPP pathway. There was no way that you could also take advantage of this credit. But the Consolidated Appropriations Act actually retroactively changed the rules dating all the way back to March 12th that you could, in fact, actually take advantage of the employee retention credit and the PPP loan. They also expanded the retention credit to the first 2 quarters of 2021. Well, let's move forward to the next slide there and go forward one more. So, like I said, businesses were not really paying attention to this because, again, you got the PPP loan, didn't matter. But with this retroactive change, now you have the opportunity to go back and evaluate potentially looking at tax credits that are on the table for 2020. And as Don will talk about, 2021 as well. The key here, though, is that you can't utilize your PPP loan expenses to calculate this credit. And we're going to get into that in a little bit greater detail, but you just kind of keep that in the back of your mind. You're really only utilizing wages that you paid above and beyond the PPP loan for purposes of calculating this credit. But the reality is that a lot of businesses could find themselves in a situation where for 2020, they're already qualified for the credit and they don't know it. So, you got to go back and evaluate what money might be on the table there. Then, of course, planning opportunities for 2021 as well. And again, that retention credit is available from the middle of March of 2020 all the way up until the end of the second quarter of 2021. The rules are a little bit different with respect to 2020 and 2021 regarding how many employees you're permitted to have, how the computation's done, et cetera. So we're going to talk about the differing rules there with respect to 2020 and 2021. As I mentioned, there's a limiting condition here with the retention credit. You cannot utilize the PPP loan expenses, payroll expenses, to calculate this credit. So, there could be an art in how you fill out your loan forgiveness application. Again, as I had mentioned before, perhaps you want to demonstrate more non-payroll costs to free up more wages to be available for this credit. Now, how's this credit calculated? Well, for 2020, businesses can obtain a 50% credit on the wages that they pay their employees up to $10,000 in wages. And that's an annual cap. So for 2020, the most that any one employee could be worth in terms of calculating a credit would be $5,000. Now that's a little bit different in 2021 and much more lucrative, but for 2020, each employee at their most could be worth $5,000 in tax credits to you. For 2020, there's a limitation on the number of employees that you can have with respect to calculating this credit. And this limitation is calculated based upon 2019. If you have 100 employees or less, there's really no limitation there. You can use all of the wages, assuming you meet the other conditions for this credit. You can use all of those wages to calculate your credit. If you have more than 100 employees, then there's some limitation there on how you can, with respect to what wages you can use. You can basically only use the wages that you pay to employees who are not actually working for you. Now, there's a little bit of a gray area here right now with respect to how do you determine how many employees you had during 2019. If you look at the IRS's frequently asked questions on this, and I believe it's frequently asked question number 49, they're referencing the Affordable Care Act rules, and what they're saying in there, I think, is that you're only counting full-time employees for purposes of this calculation. So if you had 300 part-time employees, each working 20 hours a week, I think the frequently asked question is suggesting that that count there is really zero. So you're really only looking at the 130 or 35 hours, I forget exactly what the number is, 130 or 35 hours per month to determine whether somebody's a full-time employee. In other words, we're looking at truly who's a full-time employee and not full-time equivalent employees. And that's a big distinction, and we are hopefully going to get further guidance on that. But again, if you have that specific scenario, that is question number 49 on the IRS's frequently asked question website for the employee retention credit. Now, how do you qualify for this? In 2020, your operations had to either be fully or partially suspended by a governmental order, or you had to have experienced a decline in gross receipts for one quarter in 2020 relative to 2019, where your gross receipts were dropping by at least 50%. And you might think, okay, that second bar there is a hard one to jump over, and it may be for some businesses, but the rules are a little more lax in 2021. However, a lot of businesses, or some businesses that were deemed non-essential, were actually ordered to be closed during what could have been a substantial period of time during your second quarter. So you might meet the qualifications under the first prong here, but you might also meet the qualifications under the second prong too, just by virtue of being actually closed for, a 6 or 8 or 10 week period of time. So you have to meet one of those two tests right there in order to be eligible for the 2020 credit. The IRS has expounded on what it means to be affected by a governmental order, because again, that's, I think, an enormous gray area in certain circumstances, but they do have a number of examples, and I do have some on some upcoming slides here, particularly with respect to the restaurant hospitality industry. Let's go to the next slide there. Here's an example here on a restaurant, and you can see that the restaurant's not allowed to offer on-site dining due to a governmental order. And so based upon that, the IRS is saying you're deemed to have been partially suspended. And in a further example that the IRS has, they're suggesting also that if you have a capacity restriction or if your tables have to be spaced out at least 6 feet apart, you're considered to also have a partial suspension. So the reality is that for restaurants, they've actually qualified for this credit from March 13th all the way until today, because especially in Pennsylvania, because as far as I know, there's never been a restoration of 100% capacity in restaurants. So if you're in that particular industry, you really need to take a very hard look at this credit, because you could be looking at some substantial tax credits coming back to you. We do have other examples in here. There is one right here with respect to a large retailer. If you had to close your storefront due to governmental order, you may or may not qualify for this. If you have, curbside service, or if, I'm sure people have had to wait in line at Home Depot to get in, they treat that a little bit differently than if you're able to provide everything, curbside. So, again, everybody's facts and circumstances might be a little bit different, but I just see this as an enormous, again, gray area on whether you're actually affected by a governmental order. So take a much closer look at these examples that are in the IRS's frequently asked questions. Here's an example here based upon a food processing facility that, they normally operate 24 hours a day, but, due to orders by their local health department, they have to perform cleaning exercises and such, and then cannot be operating 24 hours a day. They're deemed to have been partially suspended. And my last example here is if the state issues a governmental order, again, for all non-essential businesses to close between a particular period of time, you're eligible for calculating this credit, but only for the time that you're actually ordered to close by your state's governor. So, that just gives you a flavor for some examples on how you can be affected by a governmental order. This example also, again, comes to us from frequently asked question number 28 on the IRS's website, clearly defines how you're figuring out whether you've had a 50% reduction in gross receipts. And I'm not going to go through all the details here, but what I would point out is that in 2020, if you had a decline in one quarter of at least 50%, you're not only qualifying that quarter, but you're qualifying every subsequent quarter until you've been restored to at least 80% of your gross receipts in that quarter relative to 2019. So the big takeaway here is that in 2020, if you can find one quarter where you've dropped by 50%, you at a minimum get that quarter as a qualifying quarter and the next quarter. And with that, we're going to move to another polling question. And after the polling question, I have some examples that I've worked up with clients that I currently have, just to give you a flavor for how this computation works and the credits that are available. So I'm just going to keep moving here. This is a restaurant client of mine that had received a PPP loan of approximately $90,000. And you can see, based upon that $90,000, that implies they had a payroll of $432,000. Now, in their eyes, they can demonstrate, that 60% of this was used on payroll and 40% of it was used on non-payroll. And if we're permitted to do that, you can see that essentially we have remaining payroll left for purposes of calculating this retention credit of $378,000. Well, I'll just go to the next slide there. Okay, and so based upon that, I have $378,000 of wages that I can use to calculate this employee retention credit. And assuming that I have 35 employees in this restaurant, that means that everybody's making on average $10,800. So when I go through and apply that $10,000 cap to all 35 of those employees, I'm getting a $5,000 credit per employee, and that amounts to $105,000. And so for this restaurant that's got 35 employees, their available retention credit for 2020 is $105,000, not an insignificant number to them. Let's go to the next slide real quick here. I have another client that had qualified based upon the gross receipts test here. Just move forward to the next slide. Based upon the gross receipts test, and they were dropping by 50% in one quarter. And so when you calculate the whole calculation based upon what's left over after we carved out the non-payroll amounts, you can see for 45 employees here, they're qualifying all of them at their $10,000 cap. They're getting a $225,000 retention credit here. Again, not insignificant. The last example I have is a construction client that was actually ordered closed during the second quarter for a couple of weeks, and as a result of being ordered closed, they actually saw a reduction in their gross receipts. So when we essentially add all that together, these 15 employees within this particular company are all eligible for an approximate $35,000 tax credit. So I think the main takeaway here is that in 2020, the year is already over. Go back and evaluate whether you meet the qualifications for this retention credit. And if you do, again, each employee could be worth up to $5,000 of credits to you. And the credits come through on the payroll return. I think Don's going to mention that as he talks about 2021. But the point really holds that 2020 is already over. Go back and evaluate whether you meet any of these tests, because you now have the opportunity to take advantage of not only the PPP loan but this employee retention tax credit. We have a little disclaimer here that we did calculate these wages based upon everybody making exactly the same amount of money, and we know that within any particular business there's a wide degree of wages that anybody can make. So these examples that we have are just they're fairly generic, but these are actual real calculations when it comes down to the actual credit.
So Michael,
yep.
Thanks, guys. So Michael, before I move on to 2021, let me bounce a couple of questions off you for 2020. So when somebody goes back to see if they qualify, should the first thing they look at to see if they meet the 100 employee test, right? That's the first thing. Do you have more than 100 employees, full-time employees, right?
That's right. That's correct.
Okay. So let's assume that I have 87 employees. So I meet that test. And knowing that I didn't look at this last year because I got a PPP loan and I couldn't double dip. I couldn't use the PPP loan and the employee retention credit. Okay. So now Congress has changed the rules. The law has been changed. So now I can qualify for both. So now that I know I can qualify for both, I need to check one of the tests. Do I pass one of the two tests? The first test, did I have a 50% reduction in my receipts from year to year, from 2019 to 2020? Did I have a 50% or more reduction in my receipts? Okay. If the answer to that is yes, then I qualify and I need to take a deeper dive. If my receipts did not decrease by 50%, I can still qualify if I was shut down for some reason in 2020. For example, if I'm a hair salon, I was definitely shut down. And not only was I shut down for a short period of time, I had restrictions going forward. So I had partial shutdown restrictions going forward. So because of those partial shutdown restrictions, and those partial shutdown restrictions could be something as minimal as I was only allowed to have 70% of my chairs filled at the same time, right?
That's correct, yes. So in that case, that particular business is qualified from the very beginning and continues to be qualified to this day.
Right, so if I spent $1 million on payroll last year, I got a PPP loan for $300,000, okay? So my PPP loan covers the first $300,000. So any additional payroll that I had for the remainder of the year, the $700,000, I can qualify for the employee retention credit to the extent of $10,000, the first $10,000 that I'm paying to each employee.
That's correct.
Okay. Okay. Just again, it just helps to kind of noodle our way through this, because as we move into 2021, the ERC, the employee retention credit, has been expanded even more. Okay.
Yeah, hey, Don, before you move on to that, could you clarify that the difference between employees not working and employees working remotely, because the latter does not qualify, right?
That's correct.
Where you're able to maintain your business, but nobody's allowed into your office, for example, that's a different kind of situation that will not meet these standards. Is that correct?
That's correct. Kind of a better example would be if I owned a restaurant, I had a chef, and I paid the chef to sit on his couch and watch TV. I mean, he's not in the restaurant cooking food, he's just sitting on the couch. In that circumstance, he's not working.
Right. Okay.
But he qualifies, but he's not working.
Right. That's a good example, Mike. Okay.
Very good example.
All right,
okay, so moving on to 2021, like Michael said, this employee retention credit has been extended through June 30th of 2021. So I have 2 quarters to play with here. And the rules for 2021 are even better than they were for 2020. For example, I get a 70% credit. So like Michael said, in 2020, the credit was 50% of the first $10,000. In 2021, the credit is 70% of the first $10,000. The cap, like I said, so $7,000 per employee, and in 2021, that's for each quarter. That $7,000 cap is for the first quarter, and there's also a $7,000 cap for the second quarter. So in total, if I get all of the credits for my employees are worth up to $14,000 for the first half of 2021. Okay, Bob, go to the next slide. So the requirement.
Before we go to the next slide, Mary Lou stuck her head in here and suggested that I tell the audience we are going to have to run a little over with today's program. I apologize for that. There's a lot of information, and as you all have surmised from the time we spent together already, but we are going to run forward to finish this, and hopefully you can stay on. Thank you.
Okay, so moving on with the 2021 credit. So how do you qualify in 2021? So the first bullet point there says it's the same governmental order test that was used for 2020, i.e. you either had a partial shutdown, so basically if you're a restaurant and you're still shut down or partially shut down, you're going to qualify in 2021. Or there's a gross receipts test. So your gross receipts have to be less than 80% of your gross receipts for the same quarter in 2019. Now, it's important to point out here that is 2019 gross receipts. It's not 2020 gross receipts, which were probably lower than 2019. So that's a benefit. So again, just to say that again, if you have a 20% reduction in your first quarter 2021 gross receipts as compared to your first quarter 2019 gross receipts, you can qualify for this employee retention credit. That's one of the qualifications. So you get to compare first quarter 2021 to first quarter 2019. And then when you look at the second quarter, you can compare second quarter 2021 to second quarter 2019. In addition to that test, there's also a second test where you can look at the most recent quarter. So for the first quarter of 2021, you can look at the most recent quarter, which was the fourth quarter 2020, and compare it to the fourth quarter 2019. So you can go and look at that right now. You can check today to see if you already qualify based upon your 2020 showing a 20% reduction as compared to 2019. Michael, did you have a comment there? I think somebody chimed in there.
No, sorry.
Okay, sorry. Okay. So for the 2021 credit, you have to have less than 500 employees. Okay, so that is way more beneficial than the original test. The original test for 2020 was 100 employees. Now that requirement is 500 employee max. Okay, and the employees are eligible to be included in the employer's computation, even if they are working. So again, the most important thing, look at your receipts for 2021 versus 2019. If you qualify and you have less than 500 employees, you can qualify for this the employee tax credit. And this next bullet point just talks about the difference between 2020 and 2021, with 2021 being a 20% reduction, whereas 2020 was a 50% reduction. A big difference. One of the things to think about here is everything that we've done so far with respect to PPP, the original employee retention credit, all of that stuff happened in the past. We were looking at qualifying based upon historical information, right? Based upon things that happened, 6 months ago, 9 months ago, to see if you qualify. For this employee retention credit for 2021, you don't even know what your results are for the first quarter of 2021 are, right? So if I'm a company that had, let's just assume that in 2019, I had $10 million of gross receipts in the first quarter of 2019. Well, as I sit here on January 21st, I know what the bogey is. I know what my number is for the first quarter of 2021. I know that to qualify for this employee retention credit, I need to be less than 80% of that $10 million that was the 2019 number. So I need to strategically think and plan as to whether I'm going to qualify in the first quarter. Because if I qualify in the first quarter, I can start taking that credit right now against my payroll taxes that I'm paying today. The other thing is that I know what the number is. I know what my first quarter number is, is what the bogey is, the number that I cannot go over. So again, I need to think about whether I'm going to hit that number and whether there's anything I can do to change that outcome. And then the other thing is, does it matter how you apply for forgiveness? And that first bullet point, applying for forgiveness, talks about the PPP loan forgiveness, because I cannot double dip here. I can't take the employee tax credit on the same payroll that I'm using PPP funds for. So it's very important to understand that when you do your PPP application for your 2021 second draw loan. Again, rethink. It's going to make you rethink how you do your forgiveness application. And we talked about an hour ago, we talked about how important it was to know the split between 60% payroll and 40% non-payroll. In 2020, it really didn't matter. It matters in 2021 because the higher my non-payroll costs are and the closer that I can get to that 40%, that means there's more payroll that I can free up for the employee tax credit for 2021. And if you do the math, on this employee tax credit, the math is unbelievable how big the numbers are. If I have 500 employees, let's assume I qualify, and I qualify for both the first and the second quarter. 500 employees times $14,000 per employee is $7 million of payroll tax credit. It's an unbelievable number. The numbers are unbelievable. So, you know, we really have to think about and plan for this and see if we qualify, because the numbers are just absolutely unbelievable. And we can start decreasing our payroll taxes that we're submitting with our forms, our quarterly forms 941 right now when we're filing our payroll tax returns. Let's go to the next. Okay, yes, we talked about this a little bit, that we can start offsetting our employer share of payroll taxes going forward. And then next slide, please. And the same comment that I made with respect to PPP, the affiliation rules come into play here. So that affiliation rules with respect to the 500 employee count is important. And like Bob mentioned earlier, the affiliation rules are different for this tax credit. They're different than the PPP affiliation rules. Here we're talking about both the PPP and the ERC needs to be evaluated sooner rather than later. We would recommend that you get the PPP taken care of first and get the PPP application in, because there is a fixed amount of money that's going into that PPP, and you don't want to be left in the cold because you missed your application. While we've seen information that they don't think the PPP money is going to run out, we don't want to take any chances. We don't want to be that company that got their application in too late and didn't get the PPP money. But soon after your PPP applications are in, you should start thinking about that ERC credit for 2021, because you can start to reduce your payroll tax consequences or your payroll tax payments in 2021 if you qualify for the ERC. It's called the advanced payment. And there's actually a form out there that allows you to start taking that into account now. And the last bullet point here on this slide is, you know, take a look at 2020, because there are some opportunities available for 2020 with respect to the ERC if you meet the requirements. Bob, I'll hand it over to you after the polling question.
This is the last polling question, and we'll move on just to closing comments. I know we ran a few minutes over, and again, I apologize for that. I think, you know, it's just a lot of information to digest and get across to the audience. But, you know, there are other things that we need to kind of consider as well as we move forward here. As everybody knows, Mr. Biden was inaugurated yesterday as the 46th president, and that the current White House administration, along with both chambers of Congress, are now controlled by the Democrats. So they are going to be able to move legislation through that process, through the legislative process, much more easily than what's been the case for split Congresses for the last 2 years. So, you know, obviously, as we all know, Mr. Biden has publicized that he plans to introduce a new stimulus package with yet another $1.9 trillion in economic assistance to stave off any further drop in the U.S. economy. You know, we don't know exactly at this time what the provisions of that bill are, but it's more than possible that, you know, additional aid will be included in that bill for America's small businesses and medium-sized businesses. And we would expect that to be the case with that kind of a legislative package. In addition, we're not going to talk about them today. We can save it for another day, but there are a lot of changes in the Biden administration that will come down based on his campaign proposals in his campaign platform. And one of those was major changes in the U.S. tax law with more taxes, again, moving towards higher income companies and individuals. So it is likely that we'll have further, you know, legislation coming out of Congress, probably no earlier than May, but no later than the end of summer before they take their autumn recess at the end of summer. And what is in there in that bill is yet to be seen and discerned. We have obviously early ideas based on, again, his campaign platform, but we won't know for sure until that legislation is introduced later on. So, and the last thing we have to think about in conjunction with running our businesses as we all move forward is the, you know, with the ongoing pandemic, the speed of the vaccine manufacture and distribution in conjunction with this Economic Relief Act and, you know, probable additional stimulus coming from the Biden package. And then in conjunction with that, the hit by the tax reform package, it's going to be another challenging year for America's businesses, and our clients are no exception to that. So, you know, we will continue to monitor this as we always do. We continue to work hard to try to keep all of you informed and up to date on everything that's out there in conjunction with what our clients need to stay on the cutting edge and to be able to run their businesses as effectively as possible. To that end, unfortunately, I'm sure we're going to have future sessions like this again, either expounding on further guidance that's come out of the SBA and Treasury with respect to the law that was passed in December, or additional programs that have to deal with the Biden administration proposals and further future legislative developments. If you find in the interim, before we talk again as a group, that you need further assistance on second draw PPP loans or determining the applicability of the employee retention credit to your business, you know, we respectfully ask that you talk to myself or Dawn or Mike at your convenience. We'd be glad to help you. I think that wraps it up for today. We do appreciate your attendance. I think we have a number of questions. I don't know if we want to try to answer a few of those questions. Mike, if you have to go, we certainly understand it. Get some lunch. But if you want to stay, are you able to see the questions, Mike, first of all?
Yeah, I can see the questions, and we've been responding to some of them throughout the presentation, but there's the most recent question is, how do I get my payroll processor to put the retention credit on our Form 941? That's a great question. And I've talked to representatives at ADP, just for example, and they're asking you to, you know, calculate the credit by quarter and supply all that information to them. And as of right now, they're essentially going back and amending those returns to put the credit on there. Now, the problem with that, though, is as far as everybody can tell, an amended payroll return needs to be paper filed. And in a discussion I had with the IRS not too long ago, they were telling me that it takes right now approximately 180 days to open mail. So I don't know if the IRS is going to come up with some future guidance on this front that says you could basically put it on your most recent quarterly return and take the whole entire retroactive credit on, say, your fourth quarter 2020 return. So we'll wait to see what they have to say about that. But if you reach out to your payroll provider, they'll have more information. And if you look on the quarterly payroll return, there is actually a line item for the employee retention credit. So it is already embedded on the form.
Yeah, I do know they changed the forms, both the 941, and they issued a new form as referenced on that one slide today, Form 7200, where taxpayers can apply for refunds quickly. And that 7200, as Mike suggests, is a question as well, because that form can only be faxed. It can't be mailed or submitted electronically. It can only be faxed. So the website for the IRS, just yesterday, I looked at it, says that they're having significant delays in getting refunds under this employee retention credit out. So we'll have to wait and see what develops there. But, you know, all of these programs are taking a severe strain and stress on the Internal Revenue Service and their resources. You know, generally they've started tax filing season near the third week of January. They've moved that back to, I believe, the second week of February now, just because they're backed up with all these other programs. So we'll have to wait and see. Any other questions, Mike? We might.
Yeah, we had a number of questions on, you know, how do you define gross receipts, whether you've got to use the cash method of accounting, the accrual method of accounting. So I didn't know if you wanted to comment any further on that. We had maybe 10 questions on that.
Yeah, that's absolutely based on how you know, the methods of accounting that you generally use in conjunction with operating your business. So if you're a cash basis taxpayer, you can use cash basis gross receipts. But if you're accrual basis and have been using accrual basis, it's those numbers that factor into that gross receipts calculation. That's clearly laid out in that January 19th guidance in the definition of gross receipts, that you defer to your general accounting method in your company.
And Bob, is that how you file your tax return? Because we do have many clients that are on the accrual basis for book purposes, but cash basis for tax purposes. I assume that it's based upon how you file your return, right?
You know what, I was just going to mention that. That's a great point that I don't think is addressed in those rules. I mean, they talk about the general methods. I would assume it is your tax return, but I don't recall seeing a clarification that is specific in that circumstance. Mike, how about you?
I assume you can use your tax return to demonstrate that by virtue of that annual rule that you mentioned earlier, that you could actually, instead of looking at it on a quarterly basis, you could utilize your annual tax returns. Of course, your tax returns are going to be on either cash or accrual, whatever you decide, as long as you're, you know, following the IRS's or the Internal Revenue Code's rule on that. So, you know, I read those together as whatever's on your tax return at a minimum is the way that you can calculate your gross receipts reduction. I guess my question would be, do you have to follow that rule? But I think at a minimum, you can use your tax return methodology to do it.
That's a good observation, Mike. I would tend to agree with that, with that type of analysis. Any other questions?
Yeah, and unfortunately, I don't know the answer to this question, although I have received this question a few times over the last day or two, and I just haven't looked into it yet. But what differences are we noting at all with respect to the drop in the gross receipts for nonprofits? Because of course, you know, their income, if you will, is a little bit different than what a traditional business would be.
Yeah, I don't know if I have a specific answer to that either. Gross receipts in the January 19th distribution of data on the other day addresses nonprofits and specifically what lines are considered in conjunction with that. I'd have to take a look at that. If there are people on the call today that are from the nonprofit community that would like to specifically submit that question to Mike or myself, please do that, and we'll see if we can get a definitive answer on that. I apologize that I don't know that off the cuff.
Yeah, and that they continue to, you know, those are rules that, you know, continue to change and evolve over time. There's somebody else has a question. On their first loan, they had submitted the forgiveness in the middle of December, have yet to hear, and their loan is under $2 million. Is that a cause for concern, or do you think that's still within the time frame for, you know, for them waiting? So, I mean, right now you're at a month, essentially, a little bit beyond a month. And I think what at its most between the bank and the SBA, I think if they stretch it out all the way, they have, what, approximately 150 days to essentially come back to you with the decision, I think is the way I read it. So I don't think that a month plus 6 days is really any cause for concern at this point on a forgiveness application.
No, I don't either. I would agree with that. Absolutely.
Okay, I think those are kind of we had a number of questions in all of those categories there, so I kind of consolidated as best I could. Some of the ones in here are much more detailed and more specific, and as Mary Lou mentioned, we have a copy of this thing so we know who asked the question, what the questions are, so we can, reply as needed.
Okay. Well, again, we're about 15 minutes over. If people had to leave and listen to this later, there's no problem with that. We appreciate your attention today. We appreciate your interest in Grossman Yank Ford and joining us for these presentations. We hope the information that we were able to convey in this morning's program is helpful and gets people moving in the right direction. I think if I left you with anything, I would tell you, and Dawn has kind of said the same thing, is that the opportunities here are very astounding for economic help with your company. And so it really is critical that you take a look at this as soon as you can, because these two new programs, the second draw PPP loan as well as the employee retention credit, gives you an opportunity to generate a lot of tax-free, clear cash flow that can be of a huge assistance in a situation like this where companies have experienced protracted downturns for a good amount of time. So with that, I'll let you go. I thank Don for his time today, as well as Mike, and I hope all of you have a great day and stay safe out there. Take care. Bye-bye.